The economy is still in excess demand. It's overheated. Households and businesses want to buy more goods and services than the economy can produce, and this is driving prices up.
The Bank of Canada raises interest rates again, 50 basis points this time, up to 3.75%, up 3.5% since the start of the year. Bank Governor Tiff Macklem says more hikes are expected, though the bank is aware of fears that these policies could trigger a recession.
If we don't do enough, Canadians will continue to endure the hardship of high inflation. And they will come to expect persistently high inflation, which will require much higher interest rates and potentially a severe recession to control inflation. Nobody wants that. This tightening phase will draw to a close. We are getting closer, but we're not there yet.
The bank is following orthodox monetary policy, raise rates to discourage spending, encourage saving, and dampen inflation. The bank's mandate is to keep inflation at 2% and use only monetary tools to do it, meaning the bank can't raise or lower taxes or spending, just how much money is available. But this has drawn criticism from the official opposition and now the government's NDP partners as well.
That mandate should not be a narrow mandate that just focuses on inflation. It should also include a strong element in the mandate that looks at the impact on employment, because the sharp increase of interest rates will have a result of a recession, which will mean hundreds of thousands of jobs lost in our country.
But some economists say this conventional monetary policy is backwards.
It's all based on the assumption that inflation is a result of Canadians having too much money. There are some Canadians who have too much money, no doubt about it. But the average working person at the grocery store is not that person.
Jim Stanford says monetary tightening to control inflation came after the stagflation crisis of the 1970s, a time of high wages and prices rising to match that. Stanford says inflation now is caused on the supply side, and there are ways to relieve that pressure that don't involve rates.
Our supply chains, for example, our ports were clogged and our railways were clogged. We could have investments in a stronger infrastructure in Canada. That would help. Affordable housing would really help to take that piece of inflation out. On the energy side, we should be rolling out renewable energy systems as fast as we possibly can, not just for the climate, but also to get ourselves out from under the thumb of OPEC, which has caused much of the current inflation.
In Ottawa, Xiaoli Li, City News.